Many retirees accidentally pay far more in taxes than necessary. And sometimes we're talking hundreds of thousands of dollars over your retirement. We call this your retirement lifetime tax bill. Now, I've sat down with hundreds of families one-on-one as they're getting ready to retire, and we build blueprints and tax maps. And I've seen where Roth conversions make very little sense. And I've seen other families where proactive tax planning could potentially save over $500,000. Now, this is the same tax code and similar retirement years and similar retirement windows, but completely different outcomes. So let's dig into this on the why. So most people think taxes in retirement work the same way as they did while working, and they don't. There's going to be completely different rules. And so I want you to think about this as a rule book. You get used to playing the rules, and then, say this is football, and all of a sudden there's only 7 football players on the field, and touchdowns count for 5 instead of 6, and extra points count for 10 points. Now, if they change the rule book, it'd be drastically different. It'd be very confusing, but that's very much like it works in when someone goes to retire. So let's talk about the 2 different phases. One is when we're working. We get used to working. We have wages and a salary, maybe business income if we owned our own business. And most income is determined for you, meaning it's from a wage, and there's limited flexibility. And most people spend 30 or 40 years living under these rules, which could also include investing. And then those investments, the money you're putting into investments aren't taxed. That money grows tax deferred in those investments in many cases, meaning you're not paying taxes along the way. And then all of a sudden you get ready to retire and you start looking at the numbers, or maybe you see a video or you hear something on the radio and wow, this is completely different. So let's talk about these retirement years. I think it's really important that you understand how drastically different this is. So let's start first and talk about Social Security. Social Security has a thing called provisional income, where maybe not all of your Social Security or even none of your Social Security is taxed. Or maybe it's up to 85% goes into your taxable income, depending on other wages. So this is something that's new and completely different. Our investment income, maybe you have pensions, or maybe you were pulling money from a 401k, or maybe you got an inheritance, you're going to pull money out of a taxable brokerage account. Well, all those are going to be taxed slightly different. So we also have Roth conversions if we do those and can take advantage of those. Medicare premiums, we could have extra what we call IRMA premium, which is if we make too much money, they're going to charge us extra Medicare premium. Withdrawal sequencing, which account do we pull from first? Our overall tax brackets. Many times in the earning years, we don't think too much about our tax brackets, but during your retirement years, it can be very advantageous to start thinking about your tax brackets. Let me give you an example. So one year I had one of my clients call me in November. They had just retired earlier that year. They said, hey, we want to do a complete kitchen remodel and we want to withdraw about $30,000. Well, we were familiar with their situation. We have some special software we did. We put it in just to estimate where the tax brackets were, of course, relying on their accountant for final say. But we were looking at it, doing some estimates, and it looked like this withdrawal would push them from the top of the 12% into the 22% bracket, meaning they'd be paying 22% federal tax on all the withdrawals. Well, we knew they had retired. We knew with their tax map we had put together that they were going to drop in their income. And so this gave us a great opportunity to say, hey, how about we do this right at the beginning of the year? First couple days of January, we can send you that money. Well, this particular client didn't wait. They put it on a line of credit. They took care of it, meaning they wanted to do their kitchen now. We sent them the money as of January. That all got taxed at 12%. So you're talking, in this case, it was several $1,000s difference just saved in taxes by just being aware of tax brackets. Now, We also have a thing when you're a little bit older, 73 or 75, we call required minimum distributions, or RMDs. Those are going to begin. And those add a new thing that you've never had to deal with your whole life. Basically, the government's not going to let you get out of life with these assets, these investments that you've put in. You weren't taxed on the wages you put in. And now all of a sudden, they're going to force you to pull out a certain percentage. And if you don't pull out that percentage, at least that amount, you'll have a 25% tax. Now, there are a lot more decisions, but on the opposite side, there's also a lot more flexibility, which is great things. But my point simply is that these are different. Now, there is a golden window between 59 and a half when we can start rolling out of 401ks. Many times we can do in-service distributions and roll them over to IRAs. Many times that gives you investment choices and things like that, but also can give you some tax planning windows after 59 and a half to your RMD age, which is 73 or 75, depending on your date of birth. And so we have this window from 59 and a half and RMD age, and there's several things that can happen. This income may drop, Social Security may not have started, or we may want to delay it on purpose for various reasons, which could give you some tax windows at very low income years where we could do Roth conversions. These RMDs haven't started. You may be stopping to work, or if you're married, one of you may be stopping to work at a separate time as the other. And in other words, you may have an income up here while you're working, maybe up till 63, 64, 65, and then all of a sudden your income drops like this, even if you start Social Security. And so looking at that, you might go, okay, we have a window or an opportunity here. And that's why we call it a golden window. Now, the golden window isn't complete if you don't take a long-term perspective on this, meaning you can, we use fancy software because I've learned over the years that I can't estimate this just, if it makes sense on a yearly basis, just with my own brain, even though I've seen the numbers a lot of times. We put in everything from your income to when you're going to start Social Security to how much you're going to pull out of investments, if you're going to have any kind of travel budget or what I call a fund bucket. So we're figuring out what your income is, what your account balances are, and then we can start to estimate your RMDs. We can start to estimate what I like to think of as 3 different tax brackets. One is where you're at now, which we can generally pull from a tax return. Then the second one is we can generally pull from what's going to happen after you retire and when you're going to start Social Security. And then the third is RMDs and what will those to your tax brackets. Because you can have it later on after 73 or 75, you can sometimes, in many cases, those RMDs, when you have to pull out of a 401k or an IRA or any kind of tax deferred account, it can push you into a higher tax bracket, and all of a sudden you have this huge surprise. And then there's another problem that can arise if you're married and one of you were to pass away, which we know will happen eventually. Not to be a downer here, but there's only one way out of life, right? And so what happens if one spouse passes away and you've been in married filing jointly tax brackets? Those tax brackets will shrink considerably. You still have to do the same RMDs, and we call that the widow's tax. So we have this golden window between 59 and a half and RMD age, where we have a lot more control over our taxes than the working years. So the goal is not to have everybody do Roth conversions, right? That's not the goal. The goal is that if we do a tax map and we look at your large situation, however you come to a knowledge of that, and you can kind of see over the next 10, 15, 20, 25 years, what your tax levels are going to be. If those end up, if there's opportunities to do Roth conversions to make sense, we take advantage of them. If we look at it and it's like, there's not a lot of great advantages to this, then we simply don't. The trick is to be smart about this, right? It's not an end all be all. It's good for everybody, but every situation is different. So let's talk about an example here. So let's just say you retire at 62 and your income drops significantly and you delay Social Security because you want it to grow a little bit. You've done the math, you've logged on to Social Security, you see that I can tackle that in another video, how we look at that. If your you're going to stop working, if your Social Security is going to drop or stay the same. But nonetheless, RMDs are years away. You're potentially in a lower bracket. There's more planning options and there's more flexibility. So the mistake is this: if we assume that taxes are going to take care of themselves, meaning we treat it like we did during our earning years, where we just assume there's going to be a certain amount of wages that are going to be withheld. Those wages are not withheld if you haven't done planning around it with Social Security and your pension, and you're pulling money out of your investment accounts and you haven't withheld any of the money coming out of that. No, there's that can be a really big mistake, and then you can end up with a really surprised tax bill that's maybe higher or really low. So one mistake is just assuming the taxes will take care of themselves. I've also seen people, another mistake I've seen is that somebody retires and they look at their taxes and they're like, wow, we're not paying any tax. And they don't understand this RMD thing where they're required to pull money out at a later point in time. Meanwhile, their tax deferred accounts are growing and growing and growing, and their tax liability is growing and growing and growing. And they don't understand that when you start RMDs, each year you're going to have to pull a larger percentage out as well. And so they have this ticking tax time bomb that's just growing. But meanwhile, they're 65, they're retired, they feel good. They feel like, oh, we're not going to owe any taxes. Meanwhile, there's this ticking time bomb that can be going on. So the golden window is this, is it gives you a lot of options. And retirement has different rules than your working years. There's two different set of tax rules. Even though it's the same tax code, there's just different rules that you're going to be using during this new time period. And your intentional decisions matter. For example, when each of us go and do our taxes each year, and we sit down with an accountant or we do our taxes on our own, we're generally looking back at the previous year. We are looking, hey, what's the most ethical way that I can pay the least amount of tax as possible? But what this does when we're taking advantage of this golden window, what we're doing is we're looking forward for the next 5, 10, 15, 20, or 25, even 25 years or more. And we're saying, where are opportunities? What are RMDs going to do to my tax brackets? What kind of income do I want? Do I want to do gifting strategies? Am I charitably inclined? And you can look at all of these things and make decisions early on in this tax window that can have massive impact, not only for you, but for the people you love where you're going to leave the money. So for example, you could leave them a very large tax deferred account balance, or some people are like, no, I want to pay the taxes so I can give tax-free money to my kids. Or maybe you want to do Roth conversions because you believe taxes are going up significantly in the future with government overspending. Or maybe you believe that you just need to take care of this now. There's an urgency and you just don't want to be caught if tax rates were to go up. So there's all these different types of kind of mistakes and windows and things to be thinking about as you look at this. So one of the most important retirement questions you can ask is, do I understand my tax opportunities before my RMDs begin? Thanks. I'll see you next time. Make sure and hit subscribe.